Welcome back. The Fed is in focus today. The central bank decision due at 2:15 p.m. Eastern time. We are expecting the Fed to raise interest rates for the third time this year. Joining us now to preview it is MacroMavens President Stephanie Pomboy. Stephanie, great to see you as always.
Thanks for having me.
You're expecting the Fed to raise rates.
I am.
And the impact will be?
Well, I think the real question is what's happening longer term. Obviously, this rate hike is fully priced into the market. The 2-year note has basically 3 rate hikes priced in over the next.
What I'm asking is what the impact will be of higher interest rates.
Right. Well, my view has been that the whole monetary policy story has been ignored. It's been overshadowed by the tax cut, the fiscal policy side.
So no impact
this year. Well, I think on January 1, all of this changes because the year-on-year effect of the tax cut ends, and you have not only the Fed tightening, but you have the ECB no longer, they're going to wind down their QE program by the end of this year. And by February, total global central banks will stop adding liquidity entirely. Right now, they're running about $500 billion a year in liquidity pumped into the system. That goes to 0 in February. So I think this is a huge headwind for the markets and the economy that's been progressing silently behind the scenes. But fiscal policy, has kind of put a pin in it this year. We basically have the tax cuts kind of mitigating the headwinds of monetary policy. That pin comes out on January 1st. And I think the Fed will come into focus. Today, everyone's going to listen to the press conference and then yawn and go back to the spectacle that's tomorrow. And the whole Fed story will kind of go back onto the back burner. But I think 2019 is going to be the year where monetary policy really takes center stage.
What do you expect to hear from the Fed as far as their outlook today, and especially with regards to their interest rate plan for gradual hikes going forward? There's talk, a lot of people are talking about the neutral rate.
Right.
And what is that? Is it moving higher because we are in a, much more prosperous economy these days? Just in general, what are your thoughts?
Yeah, well, it sounds like at the margin, they're a little bit more tilting toward hawkish. You've got a couple of the former ardent doves kind of acknowledging that the economy is doing better and that the neutral rate might have to shift. And then there's talk about removing the term accommodation from the language and finally acknowledging that policy is no longer accommodative, which again goes to that. But I think that I think the question is, the more they tighten in the immediate term, the sooner, more aggressively, they end up having to ease later, just because it's a matter of time before the markets correct. I mean, like I said, this quantitative easing program has been a huge support for global financial markets in general, risk assets, and taking it away, just as QE pumped liquidity into the system and increased the appetite for risk, so should QT get the reverse. And the only reason that hasn't happened to date is that the tax cuts totally offset that impact. So I think that, if they are, I'll use the word foolish enough, but to be more aggressive on rates in the intermediate term, in the next 6 months or so, it'll just precipitate the correction that much faster in financial assets, and then they'll be, running in with the fire hoses. I mean, I think one of the things that's really important to watch is this time around, it's the corporate sector that's super vulnerable to higher interest rates. You've got now 37%, almost 40% of the S&P companies qualify as being highly levered. They have debt that's 5 times earnings. Then you have 15% of them that are zombies. They've got debt service that's greater than earnings. Then you get into the breakdown, the investment grade market. Half of the investment grade market is dangling just one rung above junk, and you now have over $1 trillion in actual junk paper. So, it wouldn't take much of an increase in rates and rising debt service to push a huge swath of the corporate market into that speculative grade category. I mean, we're going to have issues with rolling over the massive amount of debt as rates go up. Debt service is already going up. But again, because they have the windfall from the tax cuts, it hasn't been an issue to date.
So you think things slow down next year then?
Well, I think that's going to be interesting in the Fed, too. What is their forecast for growth? I mean, if we don't have a recession in the next year and a half, 2 years, I mean, it's already unprecedented, but that will really be something else. But I think the market is really going to be the story next year and how it responds to the retreat of global liquidity.
All right, we'll be watching. Stephanie, it's a pleasure to get your take on everything. Thanks so much.
Thank you so much.
Stephanie Pomboy.